A banner year and a banner decade for stocks. So what does Wall Street have planned for an encore? Let's ask our market pros. John Grace, Keith Fitzgerald, and Kimberly Foss. Kimberly, it's going to be one tough year to beat. 2019 was a pretty good one.
Yeah, 2019 was awesome. We had the S&P 500 up 34 times, rivaling that of 1997. Just a phenomenal year for everyone. So what's looking forward to 2020? I mean, I don't think we're going to look in for a recession. I think most of the analysts are downplaying that. We're really looking for strong fundamentals, earnings growth this next year. And I think with the trade tariff talks, it's going well. We're just looking for a really good, solid year. Not like this year, Charles, but we are going to look for some good, probably 10% growth maybe.
All right, well, you know what, Keith Fitzgerald, that would match what Wall Street's anticipating for earnings growth. So, it could be an earnings growth driven year. And last year was sideways, but there's so many other things that seem to be morphing in the right direction. Housing data late seemed very encouraging. Because the trade talks are now seem to be in a better footing, we can expect businesses to invest more. And then there's the consumer, powered by these higher wages and strong confidence.
Well, that's the thing, consumer spending is good, confidence is good, jobs are good, earnings are good, CEOs are in a positive mood, capital expenditure continues to go. All of this stuff looks forward, Charles, and that's very, very exciting because for all the bears who are out there and worried about a correction, you know what? Even a busted clock is right twice a day. So I look at 2020, I say this is great opportunity. The president has only got to pull off another 6% or so to keep him in the record books, and that's great for investors.
John, speaking of the president, the market normally also does pretty good in election years, doesn't it?
Yes, it does, Charles. Third and fourth time, the presidential cycle is typically very good. Hopefully, we'll continue to see a melt up. But I just have to say, it makes sense to play both sides of that fence, right? When you're walking across the street, you don't stare at your phone, you don't become complacent. You have to be, paying attention. And so we just don't want people to fall asleep and wake up like Rip Van Winkle and discover it's 2000 to 2002 all over again.
So on that note, then, John, what's your greater concerns here?
Well, when we talk about debt, the U.S. is amassed $74 trillion of public and private debt. There could be some undoing along those lines. That would be pretty scary. Consumer debt is higher today than it was in 2008. We see some institutional selling happening right now. And let's just be real honest, this job market has to continue to be on steroids. But, if you're at 60-year lows or 50-year lows for unemployment, there's only one way to turn from here.
Keith Fitzgerald, there's no doubt that the consumer has been powered by wage growth. And the evidence of that is just how much money. Our savings rate is near 8%. I should remind the audience we were less than 3% right around the time of the Great Recession. So, John makes a great point. But considering how many jobs are out there, how few workers are out there, it's hard not to imagine this wage juggernaut not even getting stronger.
Well, I'm with you, Charles. And respectfully, the boogeyman is always out there. There's always monsters under the bed or, skeletons in the closet, whatever phrase you want to use. That's what risk management is for. The stock market is a forward-looking animal, and I think with wage growth, that propels profits. Profits beget earnings. Earnings beget higher stock prices. So, yeah, we've got to be careful. That's part of the game. But investing is, again, a forward-looking opportunity, and I think 2020 is going to be a great year.
John, do you sense that we could be in the midst of that all-elusive virtuous cycle? Now, we saw for a long time where the Fed would try to get it going with a series of operations, and federal government tries with a whole bunch of things. It feels like it's been sparked, like the animal spirits were unleashed, and then all of those things have come to fruition. And so the more people you hire, the more people who go out and spend. The more people that go out and spend, the more people you have to hire. It feels like we're right in the midst of that at this moment.
We very well could be, and I'll tell you what, it also feels eerily similar to me, and that's the late 90s, right? And NASDAQ grew, fourfold increase, 100,000 went to 400,000. But around the corner, 2 years later or so, that was an 80% loss, minus 320 from 400, so we're left with $80,000. I just want to make sure that people pay attention to, if we're talking about risk, what kind of risk can you accept? What kind of risk can you weather? And how can you design the portfolio so that it might perform within your risk loss parameters? That way you can stay in the game as opposed to hold on tight to the roller coaster, afraid you're going to fall out.
Kimberly, sometime the roller coaster you got to hang on to get those long-term gains. The stock of the decade was Netflix. It had its moments when it was down big time. I can remember earnings reports when the stock was down 40%, but if you held on, you made 4,000%. 8%. So we understand perhaps volatility could step up. But overall, what is in your mind the greatest threat to this rally and to this economy?
You know, I think I think one of the other guests said it before, is the complacency. One of the things, if people get too complacent and they get thinking that, risk isn't there and that, the market will continue on its upward trajectory, which I do think it is going to be for this year. Something, like I said, a sitting president, second election, basically average return around 10.1%. I think that's where clients and my clients, what I'm telling them is, hey, control the things that you can control, right? The cost, diversification, allocation, and tune out the investment pornography. Focus on what you can control. Make sure that you can stay in the market through these ups and downs, because it's long-term investing. And remember, guys, pigs profit and hogs get slaughtered, so don't be greedy.
All right, we got some words of wisdom as we bring in the new year. Thank you all, folks. See you again soon.